Welcome to the lecture number 5 of the course on financial accounting. In today's lecture, we are going to learn the core concept of the financial accounting, which is double entry system. As we have already know, I told you in the first lecture, I think, that practically there are 5 basic elements of accounting. assets, liabilities, capital, expenses, and revenues. As an accounting student, you are required to remember an important principle while making the analysis of a business transaction, that every business transaction brings about at least a double change in the financial position of a business. There are these two changes may take place in any one or two basic elements of accounting. For there is no exception to this principle. For example, Mr. Asif purchases machinery worth rupees 50,000. This is a business transaction. It will bring two changes. Number one is machinery increases by rupees 50,000. That is an asset comes into the business, and cash decreases by rupees 50,000 as cash goes out of the business, and cash is also an asset. So both the changes have taken place in assets, which is an element. Similarly, if he buys this machinery on credit basis from Mr. A, again it will bring two changes. Machinery increases by rupees 50,000, which is an asset, and a liability increases by rupees 50,000, which is an account payable. Now let's write down some of the principles. As you already know, if you have not seen the first four videos, I ask you to watch them first, because all the learning is going into a sequence. I told you in the first lecture that there are 5 elements of accounting. Number one is assets. Now consider a business purchases an asset and we need to record it into our in our books of accounts. What we need to do, what we actually do in the accounting is we record two aspects of the transaction. One is called debit side, and the second is called credit side. Okay. Now, the rule of recording an asset is whenever a company buys an asset, we always debit the asset account. For example, we say that a company bought an asset, bought a machinery. Machinery is an asset of rupees, let's say 100,000. Now this is the transaction. A company has purchased a machinery of rupees 100,000, and machinery is an asset, and we need to record it in our books. What we will do, we create two columns. The left side column we call it a debit, and the right side column we call it credit. We write here, and we open an account with the name of machinery account. Okay. As I told you that whenever a company buys an asset, we always debit its ledger account. So we will debit machinery with 100,000. Okay. The second aspect is that we have paid cash to purchase this machinery. So we will open another account with the name of cash account, and credit this cash account with rupees 100,000. You need to remember that whenever the company purchases an asset, that is, the asset is coming into the business, we always debit this asset account. On the other side, if an asset goes out of the company, we always credit this asset. So cash is an asset, and cash is going out of the company as we pay for the purchase of the machinery. So one asset comes in, it is debited. When one asset is going out, it is credited. Okay. Now let's practice with some examples. The number one example is that Mr. A started a business with rupees 1 million. Okay, this is a transaction and we need to record it in the books of the business. There are two changes that have taken place because of this transaction. Number one is cash is increased in the business by rupees 100,000, and you know that cash is an asset. Number two is capital or owner's equity is also increased by rupees 100,000. So the second example is he opens a business bank account with rupees 300,000. This transaction also has two changes. Number one is decrease in cash balance of the business by rupees 30,000, and number two, increase in bank balance by rupees 30,000. Okay, the third example is he borrows rupees 500,000 at the rate of 12% markup from Mr. B. Okay, the two changes are here is that increase in cash balance of rupees 500,000 as the cash comes into the business, and number two, there is also an increase in a liability of the company. it is a liability because the company has borrowed the money which which the company will have to repay to Mr. B. So at this time it it is a liability of the company. So an asset is increased and also a liability is increased. The next transaction is he bought furniture for rupees 200,000 for the business. Okay. Now this transaction has also two effects. Number one is increase in furniture by rupees 200,000, and furniture is also an asset. And number two is decrease in cash balance by rupees 200,000, and cash is also a balance. A cash is also an asset. So in this transaction, one asset is increased and the other asset is decreased. The next transaction is he purchased goods from Mr. C of rupees 250,000 and paid cash is 150,000. Now this transaction involves three changes. Number one is increase in purchases by rupees 250,000, and purchases are normally considered as an expense for the business. The second change is that there is a decrease in cash balance by rupees 150,000 because the company has paid this amount and cash is an asset. And the third effect is that there is an increase in creditor by rupees 100,000 because the business purchased goods for rupees 250,000 and immediately paid rupees 150,000. The balance remains 100,000, which is payable to Mr. C, and Mr. C is a creditor and creditor is also a liability. So there are three changes in this transaction. Now the Next example is he sells goods for 900,000 for rupees 900,000. The two changes are that increase in cash by rupees 900,000 and cash is an asset, and decrease in goods or increase in sales by rupees 900,000. Sale is an income item. Income is an element of the accounting, and whenever income is increased of the business, it is credited. Okay, the seventh transaction is he sells goods to Mr. D for rupees 50,000 on credited basis. The two changes are increase in debtor, that is Mr. D, I suppose, yes. As the company has sold the goods to a person and the person promises to pay in some future date, so we technically call it in accounting language a debtor, and debtor is an asset. Debtor is a person from which we have to receive money in some future date. And the second change is decrease in goods or increase in sales by rupees 50,000. And sale is an income item, and whenever an income item is increased, we credit it. The next transaction is he purchased stationery for rupees 30,000. This is a financial transaction and it has also two effects. Number one is increase in stationery by rupees 30,000. Stationery is a consumable asset. Simply you can say that it is an asset. Okay. And the second effect is that there is a decrease in cash balance by rupees 30,000. And cash is also an asset. Okay. The ninth transaction is he purchased a weighing scale and a safe for rupees 100,000 and pays through a check. This is also a financial transaction. The two changes are: number one is increase in weighing scale and safe by rupees 100,000, which is also an asset, and decrease in bank balance by rupees 100,000, and bank is also an asset. Okay. The next example is he pays rupees 100,000 to Mr. Afzal on account. Okay. Uh, Sorry, not Mr. Afzal, it is Mr. C actually. This is the same Mr. C from whom he purchased goods of rupees 250,000 and paid rupees 150,000, and the balance was rupees 100,000. Now here in this transaction he pays the remaining 100,000 to the creditor. Mr. C is a creditor, a liability of the business, and he has been paid the full amount. The two effects are there is a decrease in cash by rupees 100,000, and cash is an asset, and there is also a decrease in creditor Mr. C by rupees 100,000, as the business has paid his liability. So these are the 10 examples of financial transactions which need to be recorded in the books of accounts. And in today's lecture we have analyzed the effects of each transaction. In coming videos I'm going to discuss more of such examples of financial transactions, and we will continue to analyze the transactions. And after the completion of the analysis of the business transaction, then we would start recording recording them in the books of accounts by using the mechanism of debits and credits. So stay tuned for the coming video. Take care and goodbye.